The wealthiest people in the world don't work for money. Your Buffetts, Bezos, Musk, like they don't work for an actual income. They have assets that earn them typically cash flow. And so they get favorable tax treatment compared to if you're just working a W-2 job, right?
Thanks for tuning back into the podcast. Today we're going to talk about why Congress writes the tax code. And these are going to be clips from my recent tax strategy boot camp. So check it out right here, guys.
Why Congress writes the tax code. So this is pretty foundational to understanding why the government really incentivizes us to do what we do. So when you really boil it down, the tax code is over 90,000 pages long, 90,000 pages long. And to be honest with you, I've probably only read like half of it because we're so niche and specialized in real estate and businesses. And that's really what we tend to focus on. But throughout the tax code, there's three big concepts here that we want to understand and what Congress really wants us to do with our money. Number one is they want you to put money into businesses. I won the fourth grade spelling bee championship, but I am not the best grammar wise, so I apologize if I misspell or it looks ugly. But the first thing is that Congress incentivizes us as business owners to hire employees, to buy equipment, buy supplies for our properties, build properties. So as a business owners, we get specific tax deductions that your normal W-2 or any other person's not going to get. Congress is incentivizing us as business owners to invest in things like those employees, like equipment, like software, like technology. The second big thing that Congress really incentivizes is investing. So investing in terms of like if you buy stocks, if you buy mutual funds, if you buy bonds, investing your money, having it work for you gets favorable tax treatment compared to if you were to earn that money at a day job. So you'll see this in a slide that I have later on, but it's not about how much money you make, but it's how you make it. And as an investor investing, so I just put this is like stocks/bonds. As an investor, you're going to pay way less in taxes than somebody who's earning full-time as a business because you don't actually work for money. The wealthiest people in the world don't work for money. Your Buffetts, Bezos, Musk, like they don't work for an actual income. They have assets that earn them typically cash flow. And so they get favorable tax treatment compared to if you're just working a W-2 job, right? And then the third thing here that Congress really incentivizes is real estate investing. Now, recently, I got to be honest, what the government is doing with interest rates, with specific types of loan products. If you bought properties in like early 2020, 2021, the 10% down secondary home loan was like the eighth wonder of the world and probably the best thing since sliced bread. But recently, the government's kind of tightened that up because they know that a lot of us investors were using that loan to buy rental properties and investment properties. And what the government is really trying to do right now because of the lack of supply in the market is they really want to make it so that those properties are being bought by those properties are being bought by homeowners instead of investors. And so the government is really disincentivizing real estate investors because they're lumping a bunch of fees and charges into some of these loan amounts. And that's the kind of a current update is they're making it harder for us as real estate investors to buy properties because they want homeowners buying the properties. But real estate investing, nonetheless, typically from a tax perspective, when you think about all the people that get a hand in the cookie jar when it comes to real estate, like you have a realtor, you have a title company, a lawyer, you have people getting paid, contractors are getting paid. The guest or the tenant is being able to be blessed with the property. The amount of benefits and tax incentives to real estate investing are off the charts compared to these other two types of activities. By far, If somebody, just to give you an example, like if somebody made $300,000 between a business and some of their investments versus they made $300,000 just through real estate investing, there's a good chance that this person's tax bill is half of what this person's bill is. In fact, it could potentially be zero. Like if all your income is just real estate income, and I'll teach you guys that later on. Like there's a really good chance that you don't pay anything in federal taxes because just how tax incentivized real estate investing is. And this is all stuff we're going to learn today. Now, current updates. If you're on my email list, which everybody on here should be, you know that I send out a lot of emails that are based on current events or current updates. And so recently, you've noticed the current administration just proposed a bill to pretty much raise taxes on what they call upper middle class. And if you've been following along over the last couple of years, it really seems that the government's trying to shrink the middle class so that it's really just rich people and poor people, unfortunately. And the middle class eventually will be just shrunk. You're either going to become rich or you're going to be poor. And there's a couple of things that the new administration is trying to pass. So the first thing is changing the top tax rate from 37% all the way up to like 39.6%. So if this new bill passes, then this is sort of the top tier tax rate that you're looking at. So what you might see happen is let's say the bill passes and it goes into law by 2025. You in theory would want to move all your income up to this year because you would only pay a 37% rate as opposed to a 39.6% rate. If you followed along for a while, like that's why I talk about the timing of your events is really important most of the time. When you do something is equally as important as what you're doing. So if for whatever reason this law passes, you would want to try to move all those income events forward so you can pay 37% as opposed to 39.6. The second thing that they're talking about doing is a raise on the capital gain rate. So they want to raise capital gains. For those that don't know, so capital gains is anytime you buy and sell an asset and you hold on to it for at least a year, you get what are called capital gains tax treatment. So that's either going to be taxed at 0, 15, or 20% based on how much money you make that year. Now, the top tax rate right now is 37%. That's if you earn money at work. If you have a capital asset and you sell it, the most you're paying is 20%. And so you can see the difference there. It's a 17% difference in capital gains rate in tax rates for you to sell a capital asset. Remember that you hold at least for 1 year, versus you earning income at a job. And what they want to do is they want to raise this to 44% for it's like anyone that makes over, I want to say it's anyone that makes over $400,000 a year. I'm not 100% sure on that, but I'm just kind of giving you guys the thought behind it is if this was to pass also, what you would want to do is any assets that you're thinking about selling, you want to sell them soon while we're still at 20% capital gain rates as opposed to 44% capital gains rates. The third thing that they're talking about doing is disallowing the 1031 exchange. So this is pretty common. Like anytime a new political party gets in office, this is normally one of the things that's on the chop block. The 1031 exchange, that's been around for decades. We're going to learn a little bit about that later, but that's pretty much where if you think of like playing Monopoly and you have the 4 green houses and you trade up for the big red hotel, that's kind of what the 1031 exchange is. They want to disallow that. So in the future, so very, very similar strategy to what we were talking about up here is if this gets disallowed, the 1031 exchange gets disallowed, we want to try to lock in our 1031s before that rule happens. So these are like the three big sort of updates that are happening right now within tax law that if you stay on my email list and you keep following along, I'll make sure to keep you guys updated about these types of things. So that way you can make better decisions about your investment portfolio. Is there any questions so far? Does anybody want to come off mute? Ask a question, say hello. So somebody had asked if when purchasing a STR in a self-directed IRA, can you explain how taxes related to excise tax, property taxes, mortgage differ from traditional? Is there a difference when preparing? Yeah, Nate will explain that when we cover the IRA/401k. That's going to be at that's going to be at noon today. So make sure you're around for there. You can ask him those questions. Does anybody have any questions about what I just talked about? Yeah, the laws are proposed. So they're not signed into law yet, but they're proposed. Yep.
Mm-hmm. Hear me?
Yep. I don't know who you are, but I got you. I can hear you. Yeah.
So I have purchased a property using a 1031 exchange. Are they also hoping that those are no longer valid and then we would owe the taxes, or are they grandfathered?
I would imagine that those would be grandfathered. I don't know 100% for sure, but I would imagine that they're grandfathered in. Yeah, I don't think they're gonna make you because you have to think about it from like a wherewithal to pay perspective. If they all of a sudden said, hey, you owe us taxes on those 1031s, where are you going to get the money to pay it? You'd have to sell the property to pay the tax. So I don't think that they're going to grandfather everybody else in, but they wouldn't, moving forward, they wouldn't let you do a 1031 exchange again, most likely. And again, all this is proposed, so we don't know for sure one way or another, but that's just my 2 cents. Oh, we had one more question come in. Sorry. Are you going to review how to qualify for a 1031 exchange, own property for many years but not rented, putting it into use as STR? Yeah. So part of the 1031 exchange is that it has to be used as a rental property, like an investment property. So if you had a property that wasn't a rental or is just kind of sitting there, I would try to get it and make it as a rental for a certain amount of time. I would say a bare minimum 6 months. You might talk to other people, they might tell you differently, but if you just 1031 exchange that, you're going to have a hard time proving to the IRS that it actually qualified for 1031 exchange purposes because it was never rented out. So the president can never make an executive order when it comes to taxes, by the way. If you ever heard the term like that requires an act of Congress, so it has to be brought up in the House, voted in the House, approved by the Senate, and then signed into law by the president. So the president can't just make these rules up. They have to go through Congress.
And if you enjoyed the podcast today, just click on the link below in the show notes, and you'll be one of the first to know the next time that I do a tax strategy bootcamp.